and welcome to today's Market Snapshot. My name's Craig Erlam, Senior Market Analyst at OANDA. Now, it's a really busy day in the markets today. We've had some economic data out already throughout the session. Again, we are seeing a little bit of caution so far in the trading session. We're seeing European indices moderately higher. We're seeing mixed trading in the US so far. The Dow's up currently 0.1%. The S&P roughly flat. The Nasdaq's being dragged lower, really. Leading the way is Apple, down around 6% after those disappointing earnings. In the currency space, we're not seeing enormous moves. The only two areas where we are seeing the biggest moves, we're seeing the pound pairing some of its recent gains. The biggest moves coming in the Australian dollar, which is currently down 2% against the US dollar, which we'll touch on in just a second. In the commodity space, we're seeing copper and natural gas trading slightly lower. Brent and WTI crude again around 1.5% higher. Does seem to be pushing through, driving itself through that important resistance level, which we've touched on previously, potentially supporting the fact that we could see a move back towards those $50 a barrel levels. Again, the weakness in the US dollar helping this. I do think the resurgence in the Chinese economic data potentially spurring increased demand going forward could be helping to drive it higher from a demand side perspective. But we've also got the fact that we've heard in recent days, I believe that hedge fund long positions are now at 2-year highs. So this could be helping spur some more buying as well. Again, these are just reports, but given that this has emerged in the last couple of days, it would start to make sense with the moves which we have been seeing in oil as of late, especially given the fact that a lot of the fundamental stories haven't necessarily justified the moves that we have seen. But like I said, let's take a look at the economic calendar and see what we've seen so far today. And I'll split it into two sections today because it is such an important day for the markets. Firstly, we're going to look at what's happened already. This is a late video sending out after the European close and already well into the US session around lunchtime now in the US. Now, we talked about the Australian dollar, which has fallen around 2% against the dollar, and you can see at the top of this slide exactly why that is. A 0.2% decrease in the CPI reading, down from 0.4% rise and a 0.3% expected reading. Now, this of course has spurred some weakness in the Australian dollar, not just because we've got the weak inflation figure, but because the Australian central bank is, I wouldn't necessarily say on the fence with regards to potential stimulus from the central bank, but it is clearly been open to the potential for further stimulus. It's been talking about the positives in the Australian economy recently, but leaving the door wide open to the prospect of further stimulus. And I think something like this week CPI reading, especially if we see one again in the next couple of we see further weakness again in the coming months, this would give it the opportunity to announce further interest rate cuts, which could weaken the Australian dollar even further and hopefully support the economy, but like I say, spur some inflation as well if this does turn into a more sustainable move. So that's why we've seen a 2% decrease in the Australian dollar so far today. We've also had a few more pieces of data. Our UK GDP was largely in line with expectations at 2.1%, 0.4% quarter on quarter, pending home sales from the US exceeding expectations as well. EIA crude inventories pretty much in line with expectations at around 2 million barrels, but again helping to sustain that move higher. The fact that we haven't seen any larger than expected builds in the inventory figure. Next thing I'm going to touch on though is going to be what we've got to come, because that is the most important thing now for the markets, and what's to come is going to have a big focus on the US and on, clearly as you can see now from this economic data, Japan. The US, we've got the FOMC decision and statement tonight. No press conference, I need to stress that, no press conference to come from the Fed tonight, so everything lingers on the decision and the statement. The decision is very unlikely to see any further stimulus from the Federal Reserve today. You can actually see from any further rate hikes. You can see from the FedWatch tool from CME Group, the link to which is at the bottom of your screen right now, where markets are pricing in around a 98% chance of no changes in interest rates today. If the Fed were to move today, that would cause enormous shock in the markets, and I just don't think for a second that the Fed would be interested in causing such a shock, given how hard the central banks have worked over the last few months to bring stability back to the markets, and successfully so. At the moment, 2% chance of an interest rate rise, so I don't think that's very likely, aside from the fact that the rhetoric from the Federal Reserve as of late has been on the more dovish scale, or at least the less hawkish. And you can even see that when it comes to the June meeting as well, 20% chance only of an interest rate hike at the June meeting, 79% chance of it remaining at 50%. So you can see here, markets are not anticipating an interest rate rise anytime soon. Now, there is going to be a few things we are going to be looking for from this meeting. The first is going to be any indication that we are going to see a change in June. Now, of course, as I've just showed you, the markets are not anticipating a move in June. In fact, the market's only anticipating a move if we do see one right at the end of this year. So if the Fed suggests, like they did towards the end of last year, that the next meeting is live and that we could see a rate rise at the next meeting, if they play down the global risks to the economy, the financial market risks as well, and they maybe play up the rise in inflation, which we've seen recently, even by the Fed's own measure of inflation, the core PCE price index, then this would open the door to further monetary tightening at the June meeting, and that's when you'll start to see markets pricing in more. That's when I would expect to see the dollar start to appreciate in the coming days, and starting, of course, with tonight. That's when I'd expect to see Treasury yields on the rise, and that's when I'd potentially even expect to see a little bit of a shock in the equity markets as well. We do tend to see equity markets respond negatively to unexpected tightening warnings from the Federal Reserve. Now, also tonight, as you can see clearly from this economic calendar, there's going to be a lot of focus on Japan. Now, there's a lot of economic data to come, CPI data predominantly here. We've got retail sales as well, construction activity, job applications, unemployment, lots and lots of data. So I expect the Japanese yen to be quite volatile overnight. But if this was just economic data, I would, like I said, expect it to be volatile. We've also got a central bank decision. Not only have we got a central bank decision and a press conference to follow it, we are expecting the Bank of Japan to announce further stimulus measures at this meeting. We're expecting the potential for a reduction in the lending rate, as was hinted at late last week by a Japanese official, the lending rate into negative territory for the first time. This would effectively mean that the central bank is looking to pay the banks in Japan to borrow from it in order to hopefully stimulate the economy, help spur some growth in the economy, spur some inflation in the economy, given the fact that it has been lackluster once again. And I think ultimately the idea is also going to be to send some weakness back into the Japanese yen. The yen has appreciated quite considerably so far this year on the back of the risk aversion trade predominantly, but also as well following its cut to the deposit rate previously. This actually did spur some further strength in the yen. People were thinking, considering the damage that this could potentially have to the banking sector, and I guess they did not see the positive ramifications that could come as a result of this rate cut. And we have seen a lot of strength in the yen ever since this period, so maybe a cut to the lending rate, but also I think this could be accompanied by an increase in the asset purchase that the Bank of Japan will be looking to do, potentially even widening the base of the assets that would be available for the central bank to purchase as well. So all of this combined with the economic data means we could see a lot of volatility in Japan tonight. We could see a lot of volatility in the Japanese yen, in the Nikkei as well. But I'd also stress that this could filter then through into other markets as well. So I want people to be extremely wary when it comes to this. This is a lot of economic data and a lot of major economic announcements to come out in a very short period of time, starting with the Fed decision later in the statement, but then following through into Japan overnight. A lot of economic data, and another key major economic announcements come from a central bank with further stimulus measures expected as well. So if we do get them, we could see a lot of volatility, but also because they are expected, if the Bank of Japan holds back once again, then we could see another strengthening of the yen. I do think the weakness in the yen, which we've seen in recent sessions, is driven by expectations for stimulus from the Bank of Japan. So you could expect to see potentially an unwinding of these positions in the event of the Bank of Japan deciding against further stimulus on this occasion. For more in-depth news and analysis, check out OANDA MarketPulse at MarketPulse.com. You can also find out more about OANDA and sign up for a free demo account at OANDA.com. Here you'll also get access to OANDA Forex Labs, which has a lot of great tools designed to help you with your trading.